Good afternoon and good morning to those of you calling in from the US. My name is Lars Østereng and I'm covering shipping equities here at Arctic Securities. Today we have the pleasure of hosting our first shipping event of the year. Unfortunately, it's still Teams and digital only. But regardless of that, we are very excited about today's lineup. We have 3 CEOs of 3 different companies representing 3 different shipping segments. We have Konstantin Bach from MPC Container Ships. We have Lars Christian Skarsgård from Bell Ships, and finally Lars Barstad from Frontline. So containers, dry bulk and tankers in one session. Obviously, the 3 segments saw quite different fortunes during 2021. Container rates reached all-time highs, dry bulk rates reached levels basically not seen in a decade. While the tanker market has indeed remained quite depressed. 2021 is obviously history, and I think that, or I hope that with this session we might get a bit more color on what to expect going forward. We will give each of the companies around 20 minutes to present, and then we'll follow up by with 10 minutes of Q&A after each company presentation, and then repeat for the next company. That means that you can ask questions during the entire session in the Teams Q&A box in the Teams app. With that, I think I'll just leave the word with our first presenter of today, Mr. Konstantin Bach of MPC Container Ships, who, as most of you probably already know, released some exciting news yesterday. Konstantin, the floor is yours.
Great. Just unmuting as usual, a Teams issue. Yeah, thanks Lars Bastian, and then thanks the Arctic team for having me and for allowing me to run through some of the updates on the container market and in particular on MPC Container Ships. Let me start off, and I hope you can now see the presentation, with a short update or short intro to the company, a bit of a backdrop. I mean, we are, as MPCC, a leading tonnage provider with a focus on serving specifically intra-regional trade lanes. We currently own 66 container vessels between 1 and roughly 5,000 TEU, and as such, we are the largest tonnage provider with this specific focus on intra-regional trade. You can see on this slide the different trading patterns. So we have a focus on basically serving trades globally, but with a bit of a focus on intra-Asian trade, intra-Americas trade, and intra-European trade, if you want so, which is, I would say, the normal distribution of feeder or smaller vessel trades. You also see the average age of our vessels is somewhere between 14 and 15 years. I think that is in fact a sweet spot, and I'll elaborate on why I think so in a few minutes. Now let me give you an update of some of the news that we have communicated just yesterday evening. We have kind of going into 2022, actually a market that is even stronger than it ended in 2021. Various indices such as the HAPEX index are at historical highs. And furthermore, and I think that is a bit of a shift over the last 3 to 6 weeks, actually, we have seen more and more forward fixtures in the market, and the forward fixing mode has changed from the usual 20 to 30 days to almost 300 days in advance of an expiry of a charter, which is, looking back more than a decade, is a very unique feature in container shipping and underlines the strength of the market beyond pure rate and period extensions and increase in rates. But more on that in a minute, in particular on that phenomenon as far as our own chartering activity is concerned. Looking at MPCC, I can report that we have completed our balance sheet optimization in December 2021. And we now look at more than 30 vessels being unencumbered, providing a lot of flexibility. In addition, we have sold one more vessel just recently, and we have concluded over the last few weeks 7 additional multi-year charters at attractive rates. And as I said, in most cases, also well in advance of the actual charter expiry, securing additional cash flows. Furthermore, as a result of that, we have increased our revenue and EBITDA backlog. Revenue backlog presently is around $1.2 billion US, and the projected EBITDA backlog basically is more than 850 million, also providing significant visibility for the years ahead. And finally, and very relevantly, we have now completed the handover of 6 vessels that we had agreed to sell end of last year. And this now provides a lot of capacity in terms of event-driven distribution capacity of 150 to 160 million, or roughly 3 NOK per share. And I will elaborate on that in a bit more detail as we go through. Finally, the emphasis in terms of capital allocation will be placed, as we have communicated last year, on the execution of our distribution plan. We have hence last week convened for an EGM to be held end of January in order to implement our distribution plan and obtain the necessary authority from the shareholders to commence our strategy of returning capital to investors very shortly. Now turning to some of the market aspects, here on the top left, you can see the freight rate developments, obviously a picture that is not dissimilar to the quarters or the previous quarters. Basically, we have an all-time high kind of box volume, and we have an all-time high freight rate index, obviously reflecting the spot market. In addition, and that's worth noting because it's the same on the charter market and on the freight market, the contract durations continue to increase. That means also for our customers, the liners, their visibility on cash flows has increased significantly. Usually 3-year contracts now at fixed prices can be secured on the main lane trades, which provides the visibility and is obviously a positive for the overall constitution of the industry. Furthermore, asset prices, top right, have continued to rally, all-time high. This is now the example of a 15-year-old 2,800 TEU container vessel, but more on that later on. And finally, when we look at the TC rates at the bottom left, it's the index. We see also that is at a very substantial premium. It is worth noting that this chart only reflects 6 to 12 months time charter rates, whilst we're currently looking at a changed structure in terms of the charter market, and we're looking more at 3 to 4 year charter rates in our size bracket. And hence, that is a very important differentiation. And on that note, I would like to comment a bit on the structural changes in the industry on slide number 5, where next to the time charter, solid time charter rates, we are also looking at very interesting additional ingredients, one of which is on the top right, the increased periods for vessels up to 5,000 TEU, our size bracket. And you can see on the right line there that we are seeing an increasing period business going forward. And at the same time, at the bottom of that chart, at the top right, you can see that the redelivery spread has become tighter and tighter. That in turn has translated, bottom left of this chart, of this slide, has translated into fewer and fewer vessels being available forward. So the forward availability of vessels is simply very limited as a result of vessels being chartered in for prolonged periods, and hence a way less sizable spot market being available to charterers. Both of these features have already been present last year. The more interesting part, because that's a very recent development, is what you can see at the top left. And this is what I alluded to earlier, forward availability and in particular forward fixtures. We have been able to fix a number of vessels forward, up to 10 months forward actually. So you can basically discuss almost all charter positions in the year of 2022. Having said that, there is not a dialogue on every single position, but on a number of forward positions, we are actually engaged into a dialogue and have been able to conclude charters. And that can be seen on this chart, where you see days at the bottom. The dark lane is basically bottom, or is basically forward fixture activity, and usually it's 20 to 30 days, as I've said, and this is now up to 9-10 months, which is a very unique development and underlines the concern of operators about the scarcity of assets throughout 2022, as you can now fix out these vessels. Very interesting development, and very recent development, in fact. Now, what does that do in terms of our very own portfolio? On this slide, you can see kind of at the bottom the 7 most recent multi-year fixtures that we have been able to conclude. As you can see, I mean, we have illustrated the vessel types between 1,300 up to 3,500 TEU vessels are chartered out, all basically for 3 years plus, and the rates have been actually above last done end of last year, and that even on forward positions. So we're basically looking from today's perspective on some of these vessels on basically 4-year in cash flow visibility on that basis, which is a very attractive in our view at these levels, and provides a prolonged visibility of earnings. I think a very interesting fact is, for example, looking at let's say the Cimbria in the middle of that range, where we have been able in December to agree on an October extension, basically, which is a very unique feature. And we believe this is going to last for the next couple of weeks and months in any event, if not throughout 2022, that you are able to forward fix vessels. So that's one thing, the forward fixing activity and how that translates into our portfolio. Furthermore, we have sold one more vessel out of our 50/50 JV, the IS Patricia, end of last year for 34.3 million. We'll get to that later on. Vessel to be delivered in the course of the first quarter. And we have also handed over the 6 vessels that we had previously communicated sold end of last year, and the cash is now sitting on our bank account ready to be distributed to shareholders, and that is what we intend to do with that capital. Now, on a corporate side, just quickly, balance sheet optimization, I alluded to that. I think the key feature is we have actually done a combination of things. We have reduced debt, we have freed up collateral, and we have a very high discretion now about capital allocation decisions going forward. Roughly 50% of our fleet is free of or is collateral free, basically, and hence we can really dispose over the fleet in terms of our capital allocation decisions. Very important step towards our distribution plan. Furthermore, on the back of that, last week we have convened an EGM where we have communicated our distribution plan, which is footed on 2 pillars. One pillar is a recurring dividend based on our quarterly earnings, and the initial dividend on that basis is planned to be to commence with Q4 announcement, which is basically end of February, 24th of February, we will release the Q4 figures. And on that basis, we will calculate 75% of adjusted net profits, adjusted, for example, for vessel sales and one-offs, obviously, and that will be distributed to investors. I'll get to the maths behind that and some indicative numbers on that later on. And the second pillar is event-driven distributions. In a market of the dynamics that we see at present, you know, vessel sales are an option since we can monetize a lot of value, and we are committed to distributing out event-driven distributions as well. So that's kind of where we are on the distribution plan. Now moving forward, we will continue to deleverage the company. We believe that's the right thing to do. We have a significant operational leverage inherent in the fleet and distribution capacity. So we believe that's the right thing to do. And secondly, disciplined growth is on the agenda, so we will not grow at any price, but we will always look at kind of being EPS accretive for the overall company and hence for all shareholders. Let me run you through kind of the distribution capacity, and from left to right, we basically have shown the vessel sales that we've carried out. I will not run through all the details, but what we have done is we have sold 11 vessels. We have one more vessel handover pending for the AS Patricia. So we will generate or have already generated almost 300 million in gross sales proceeds. Part of that needs to be adjusted for JV shares since some vessels were held in JVs that we've sold. And we will then look at 230 million roughly of net sales proceeds. We have used part of that to execute the refinancing, and that leaves around 150 to 160 million in distribution capacity. This, again, on the back of the EGM that we have convened for end of January, where we will ask for an authority to approve dividends. We will then kind of distribute that capital within short to investors. So quite a sizable dividend ahead of around 3 NOK. And we are excited to be in a position to commence with executing our distribution plan. Now, next to kind of vessel sales, let's look at the backlog in terms of revenue and charter backlog. This is a chart we have shown in the past, showing our kind of TC cover. Top left, you can basically see from left to right quarterly days fixed and days open. So the dark blue part of the columns is days fixed. The light blue part is days that are open. And further to the right, you can see that on an annual basis. So we have around 82% of the available days in 2022 already fixed and covered. And at the top of that column, you can see the red circle where we have shown the contracted revenues. So we have already today, on the basis of only 82 days, covered roughly 100 million more revenues than we have secured for the full year of 2021. So there is a very significant revenue backlog with still significant number of days and hence further upside available. And that obviously runs through the years. Even for 2023, we have almost 60% of the days and 340 million of revenues covered. This is obviously developing favorably, in particular in light of the forward fixtures. And on that note, at the bottom left, you can see what we have kind of in terms of upcoming charter renewals. Obviously, in the past, you were looking 30, 40 days ahead with new renewals. Now you basically look at the full year on the basis of this forward fixing development that I have alluded to earlier. And hence the 19 vessels that we have available for the charter market in 2022, many of them might even be fixed within the next couple of weeks and months. On the right-hand side, we have shown the Clarksons 3-year charter rates, and you can see the gray circles above the columns on the left-hand side basically signal the revenues that might be locked in on the basis of current charter rate environment and period business based on the upcoming charter renewals. Now, how does that translate into kind of expected earnings? And this is, again, please take this as an indicative sensitivity. We have basically looked at the open days for the years as per the previous slide, have applied different rate assumptions. On the top left, we have applied the rate assumption of Clarksons 3-year contracts or charter rates. You can see that here roughly for our vessel basket, specifically for our vessel basket, that is $36,300 a day. If you apply that on the open days for the years ahead, this is the operating revenues, adjusted EBITDA and adjusted net profit that would be generated. And then we intend to apply, as we have communicated, 75% of adjusted net profit as recurring quarterly dividend to be calculated quarterly, distributed quarterly to investors. And at the bottom, we have calculated the same thing with the Clarksons 20-year historical average of $14,000. Obviously, lower numbers. I personally do not expect the market to come down anytime soon, given the current market constellation, not just the disruption, also the volumes that are available, but all of that to come into play also throughout 2022. That in turn, and then I'm happy to open the floor for discussion and questions, that in turn would translate on that basis roughly to a quarterly dividend of slightly north of 1 NOK, so 50 to 65 million per quarter for 2022. And depending on scenario A or B or somewhere in the middle, we would obviously have further upsides if the market stays where it is. So we are excited about the container market. We are excited about 2022, about the ability to secure further cash flows going forward, and certainly to initiate our distribution plan, commencing with the expected EGM to be held next week. And on that note, Lars Bastian, back to you, and obviously to the floor for hopefully a few questions and a nice discussion about the container market.
Amazing how the container market has actually turned since the early stages of the pandemic. And I think you mentioned, and we all also seen that sort of in recent fixtures, that actually the market seems to have tightened somewhat in 2022 compared to, let's say, the last weeks and maybe even months of 2021. So would you attribute that to an increase in volumes, or is it just more supply chain disruptions you're seeing?
Well, I think there are a few factors. Usually, the end of the year is already a bit calmer, and the beginning of the year is a bit calmer. I think this year around, people have, especially on the liner side, have tried to be a bit more disciplined in actually chartering in more vessels, although they've seen the requirements, simply with the expectation that the market would cool down. But the opposite has been the case. I think if you look at forward availability, as I said earlier, for vessels, usually if you go into a new year, you have around 1,600 charter vessels that would come open throughout a year. That's historical average. This year, 2022, you probably have 500 vessels to become available in the charter market, so less than 1/3. So it's really the scarcity of positions. People look at the positions and they see that people sell vessels to the liners, so the vessel will leave their service, or simply forward extensions to make sure you secure your service and can maintain your schedule. And I think this is the big difference, that with the start of the year, people have realized that it's not about waiting until Chinese New Year as usual and lay your cards. It's really the scarcity of assets that is imminent in the system, and the order book for deliveries 2022 is very, very limited. Obviously, we have seen a lot of orders recently, but this is 2024, 2025, right? So I think everyone is aware that there are good volumes, there is a system which is disrupted, and there's a scarcity of assets.
Yeah, thank you. And just as a reminder to the audience, you can ask questions anytime during these sessions. You also, Konstantin, mentioned the increase in, let's say, forward fixture, and talked about almost 300 days in advance. And obviously, as a listed company, you disclose your charter portfolio all the time, and it's readily available. You can see when every ship expires. You must be getting a lot of calls from brokers and charterers on that position list all the time, right?
Yes, there is a constant dialogue, and as I said, I think the beginning of this year is something that I would argue no one in the container industry has ever experienced, because the first 2 weeks of January were so busy. I mean, 5 of the fixtures we did in the first 10 days of January. So that gives you an idea. This is a constant dialogue, and this is not a clear extension with the existing charterer. It is quite a discussion with many parties who are interested in taking on vessels because of the scarcity. So indeed, it is a very constant dialogue and a lot of incomings. And I think people now realize, you even see that 2023 positions are already being chartered, right? So that gives you a flavor on the ability to conclude these deals, and also on the fact that the liners are considering the various charter books out there. And with 20 ships or 19 ships left for this year, we are one of the largest owners that still has exposure, and that despite our significant backlog already.
Would it be possible to, you know, I'm putting you maybe a little bit on the spot there, but to give a sense of how many charters per open vessel you see?
Well, certainly the tide has turned. If I tell you, beginning of the pandemic, we had, there were probably 10 vessels competing for one potential requirement on the charter side. I wouldn't say it has flipped, but I mean, on each ship, you at least have 3 or 4 leads, sometimes even more, in terms of charterer interest, and that on forward discussions, right? I think on a vessel that just runs out of charter, this is one thing, but I think more interestingly, it is relevant for forward positions where you even have different discussions, and that's interesting. So I would argue 3 to 4 parties in any event.
Yeah, and one question that is of relevance here, and maybe one of the biggest concerns of many investors is obviously evolving around counterparty risk, combined with the fact that the order book for especially the larger vessels is pretty sizable. So how would you respond to, an investor thinking that maybe a charter done for 3 years today with 1 year forward delivery at sky high rates? How would you respond to an investor that might think that charter party would not be honored if the market corrects?
No, and I fully agree on a shift in risk profile from, let's say, a market and employment risk towards a counterparty risk. I mean, that is an obvious development that we have observed over the last 12 months or 18 months in particular. Having said that, I clearly argue that also the counterparties have somewhat strengthened their balance sheet. If you look at the balance sheet of the liner companies over the last 12 months, they have been way more robust. Also, their contract visibility is way longer. I think that is critical. We have basically seen a shift from the last 10, 12 years where owners and liner operators basically had only a short visibility on their contracts, on their cash inflows. So that made the market a bit more of a spot market. Now, liners get longer contracts from the shippers. So some of the risk of visibility is now shifted towards the shippers and the freight forwarders, who have in the past earned a fortune over the last 10, 12 years, even in what we would call a bad container market, right? Because things got transported anyway, right? So I would say it's a bit of a risk sharing that has taken place. And that is important to note. And with increased visibility, also the counterparty risk is then shared on more shoulders. And on 3-year contracts, I'm not concerned. In some instances, we have actually also agreed front-loaded charter rates. For example, where we have a 1,700 to a counterparty, where we would say, well, we want to hedge our risks. We have significantly front-loaded the rates, 30,000 on average, but first year 75,000, for example, and then scaling down. So we take measures to address this risk, but at the same time, I think this risk is significantly lower than it has been a few years ago.
Thank you. So. And we also got a question here on regulations, and I guess you've have received this question quite a lot of time, but I think it's relevant still. So how do you assess the impact of the EEXI and CII on the container market? I mean, we've been talking about slower speeds and so on, and also how do you think that your fleet will perform under new regulations?
Well, obviously, EEXI and CII is very relevant for the industry, for all sectors, but certainly also for the container sector. I mean, the container sector is a slightly different animal. I tend to say container shipping is not shipping like tankers and dry bulk, because it's just, it's part of a logistical chain, and that comes with benefits and disadvantages, so to say. At least it's very unique because you are part of a supply chain, of a quite complex supply chain, and I think that is very important to note. So the sharing of certain risks is very relevant. If you look at EEXI and CII, vessels operate in a schedule. So slow steaming is certainly something that will happen inevitably. I mean, that's a given. Not on all trades, not for all vessels, but in general, the fleet will slow down as a result of the new regulation. Now, when you look at our fleet, and I think very importantly is also the question of when will things kick in, how will that affect trades. I think in general it will be positive on capacity because we will see slower steamings. We have taken certain measures, in particular on the EEXI side, where some of the vessels will be basically equipped with engine power limitation kits. So we will reduce also at least the possible speed of some of our vessels. But overall, I don't think that over the next 2 to 3 years it will have a significant impact. We will see how the ratings will basically end up, in particular on the CII, which in my book will have a more significant impact. But we generally have clauses in our charter parties that vessels can only be operated according to a certain CII rating. What that means in practice, time will tell. But this is something that we can basically run the vessels slower than in order to be in compliance with the respective CII, etc.
Thank you. And I think we can have one final question before we need to move on to the next company. So shipping is obviously cyclical and it's up and down all the time. This question revolves around what your main concerns are and what could possibly kill this upcycle.
Well, it's in the end, shipping is supply and demand, right? So the killing could come from the supply or from the demand side, or from both. I personally think when you look at container shipping at this junction, we see, at least for 2022 and the first half of 2023, rather limited supply growth. So at least the supply is carved in stone. After that, we have quite a sizable order book in containers. We have seen the biggest ordering spree ever last year, mainly in the large segments. In the smaller segments, I would actually argue we need more orders in order to be able to replace the fleet, the aging fleet in the smaller sizes over the next 10, 15 years. So I think on the supply side, at least for the, let's say, short to midterm, we are pretty safe. And then there's the demand side, and we have obviously, especially in container shipping, experienced quite some interesting demand impacts, be it trade war, be it later on the initial part of COVID with basically a complete halt of volumes, and then the significant pickup and the subsequent disruptions. So I think anything that would have a abrupt implication on demand would obviously be significantly negative. But if that is your base case, then you should not get involved in container shipping anyway. So I think that is something we can cater for by logging in good contracts with solid counterparties. But that, in my view, in the short term, the higher risk is the demand side, and in the mid to long term, it could probably also be the supply side. But I do not see that over the next 5 years in any event.
Thank you so much, Konstantin. I'm sure that if you have more questions, I'm sure that Konstantin and team will be willing to answer at a later point. Now we need to move on to the next company. So again, thank you, Konstantin.
Thank you. Take care.
The next presenter is Lars Christian Skarsgård, who is the CEO of Bellships. Since Lars Christian joined Bellships back in 2019, the company has completely transformed and now has a fleet of 27 modern Ultramaxes. Apart from all this growth, Bellships has also been very active in the period market lately and has actually built up a substantial backlog of charters at rates which on our numbers would point to, you know, P in 2022 of below 3. So with that, I think I'll just leave the word with you, Lars Christian.
Thank you. Thanks for the kind introduction, and thanks for having me. What you see here is one of our vessels, an Ultramax, which we took delivery of shortly after I joined as well in 2019. And this vessel we bought as a resale, where we stepped into an existing new building contract with less than 3 months till delivery. This also shows the largest vessel size within dry bulk, equipped with cranes. And this is a point I'm going to come back to, why we feel it's important to bet on the same side of economy of scale, which has been a trend in dry bulk shipping for more than 30 years. So Ultramaxes are the biggest vessel segment equipped with discharging equipment, cranes, whereas you have Newcastlemaxes, which are the biggest without cranes. And this gives us the most versatility in terms of trading patterns. We transport more than 100 different cargoes per year, and it significantly reduces the downside, which I'll also come back to why we feel it gives an increased risk reward. An overview of Bell ships. We have 27 of these vessels, and I believe we have the newest fleet within the segment worldwide, with an average age of below 4 years. This also greatly reduces risk in terms of future possible regulations, and we don't believe we have to invest or modify our ships until 2030 actually. And the mentioned EEXI calculations and regulations expected to come next year indicate that our fleet already passes. We've grown a lot over the last 3 years, but it's been a vital point for us to maintain the solid balance sheet and maintain actually a flat cost base, which we have done for the past 3 years with a low cash break even. We put a high degree of integrity into being transparent. We like to tell investors and people what we buy, what we pay, what we borrow, interest rates, what we charter, etc. So hopefully I'll show that going through this presentation. Also, what puts us apart from an asset play company is that we have a trading and operating business called Lighthouse Navigation, which has an extremely strong track record, and which I'll come back to. As mentioned in the intro, we've expanded and grown the company a lot over the past 3 years. We purchased 20 new so-called eco vessels, and all but 2 of these have already been delivered. The net cash invested in order to acquire these 20 vessels is actually negative by 4 million. And this has been a key in the strategy of growing Bell ships. We managed to finance this because of 2 different things. Mainly, we've sold the 9 oldest vessels in the fleet, taking out every single so-called non-eco vessel in the fleet. But we've also had access and expanded our leasing arrangements from the Japanese market. And out of our fleet of 27 vessels, 2/3 of our debt is financed through long-term leases in Japan. And the unique part of this, compared to normal leases here in Europe, is that we have fixed interest rates for up to 10 years, and we have purchase options during the lease, but there is no obligation to purchase the vessel at the end. So when you have 17 out of 27 vessels financed this way, we can actually turn around the company 180 degrees in 2030 if we have to. It gives us an unparalleled flexibility, and it gives us actually, as I mentioned, 2/3 of our debt is on fixed interest rate basis. Also, we invested $5 million a little more than a year ago to expand Lighthouse Navigation. And all of this has led us to a company today which has a brand new fleet, a low cash break even of 10,500, We haven't updated for 2022 yet, but if anything, we expect to actually communicate a slightly lower cash break even for 2022. Even though we bought 11 new vessels last year and we've taken delivery of all but 2 of them, we actually started to pay dividends already in the second quarter last year. And our dividend policy states that we'll pay out 50% of the net result going forward. Through these measures over the past couple of years, our share liquidity has gone up more than 10 times, and also our market cap has done the same. If we go back to the Q3 report we published in November, we're less than 4 weeks away from our next quarterly report. The Q4 report will be out 21st of February. The important part from our last quarter report was that was obviously a strong quarter, but already at that time we indicated that Q4 was going to be even stronger. And if you look at the contract coverage that we communicated back in November, we had fixed close to 80% at 29,000 net per day, almost 3 times the cash break even of our fleet. Obviously now having covered the entirety of Q4, we expect to end up close to this guided figure. Also, and an important point, even though we expanded heavily last year and we've taken delivery both in Q3 and continued in Q4, you see our cash position has continuously been building throughout last year. And in Q3, it passed $100 million, which is more than a quarter of the current market cap of the company. This also solidifies our ability going forward to continue to pay dividends. I mentioned Lighthouse Navigation, and this puts us apart. We like to extract value from trading and operating the vessel segment that we know, Supramaxes and Ultramaxes. This company was founded in 2009, and it hasn't lost money a single year after that inception year. So we have 12 years in a row with an annual profit, which I think is unique. And one of the main reasons for this is that we have a setup with people which have been working with us for a long time. And we also have a setup where the leading employees own shares in Lighthouse Navigation. So they have real skin in the game. So 1st of January every year, they protect the cash, they protect the equity. And I think that's one of the main reasons that this company hasn't lost money on an annual basis for more than a decade. I mentioned earlier, we made a modest investment to hire more people, and we've now expanded over the past year in both Oslo and Singapore. And we have now 4 offices in Asia and Europe. And over the last couple of quarters, we've averaged around 70 vessels operated in this company. And this is mostly contracts for 1 cargo against 1 ship, or 2 cargoes against 2 ships. So it's very spot and near-term focused. And as of now, more than 80% of the exposure in this company is actually in the same quarter we're in. The financial performance of the past 4 quarters indicate an average EBITDA of $11.5 million. And if you look at this company, which has no debt, a healthy cash position, we invested $5 million 1.5 years ago to more than double the size of the number of employees and trading. It gives you an indication that this is an extremely profitable niche and a very good added value to owning the Bellship stock. I mentioned earlier the attractiveness of betting alongside the economy of scale, with Ultramax being the largest geared vessel. But if you look back over the last 3 years, you can see the average earnings of 3 main classes within dry bulk: Ultramaxes, Kamsarmaxes, and the bigger Capesizes. And the trend is the same if you look back 10 years as well. So there's nothing extraordinary over the last 3 years. And 2019 was a normal year. 2020 was an extraordinary weak year, and then last year was a strong year. And Ultramax has proven to be the most resilient segment. Over the past 10 years, in every down cycle, it outperforms the bigger classes. And in an up cycle and in a high market, they all earn decent money. But if you look at the compared with the Kamsarmax, it basically earns better rates, but it costs 10% lower. And if you compare with Capesizes, our ships cost 40% less to buy. But over the past 10 years, an Ultramax hasn't earned less than operating expenses a single time. So in my view, there's much less downside and therefore a much better risk reward when investing in dry bulk. If you look at one of the main topics of the past couple of years has been the low order book, and this is a trend which is persisted actually for a few years, because already 5 years ago you saw a clear trend that shipbuilding capacity for dry bulk was reducing, and for the past 5 years really there's been a downwards trend with contracting activity, and it's actually been net negative since 2018. So where we find ourselves today is that the order book for our segment, the geared vessels, is barely 6%. And the geared vessel segment is also the oldest part of the entire dry bulk market. So Bell Ships has positioned itself with the newest Ultramaxes, whereas the order book consists of merely 6%, which is the same number of vessels which are more than 20 years old. This is also the main supporting factor when you look forward on 2022, 2023 expectations. And since COVID broke out, since the pandemic, you've seen an extreme stimulus and economic growth initiative, first in China, but then also in US and Europe. And this historically in dry bulk tends to have a 12 to 24 month lag. So even if we're seeing the end of a pandemic, most of the stimulus and economic growth initiatives tend to have an effect on dry bulk the following year. It's also worth mentioning that in the context of the green shift, it's quite evident actually that this is actually added to a big infrastructure boom, which started in China many years ago, because every project you read about in the green shift basically starts with a construction project, and that takes out sand, cement, steel bars, steel, and this goes directly into the commodities that we ship. So when you add green shift effects projects, you add the infrastructure boom which has happened in China, and it's brewing in Europe and the US, and then you have an energy crisis on the top of that. You have an extremely strong backdrop to dry bulk demand. And if you look at dry bulk demand over the past 30 years, you've seen an extremely stable growth of 3 to 4% annually. And then you basically have a supply side which tends to regulate the outcome on the rates. So if you look at the market today, the year has actually started on a weak note sentiment-wise, but we have very, very strong rates. And in the Ultramax sector, which we operate in, we are at more than twice the cash break-even levels. I'll come back later to show you what we've done with the market over the past 6 months, which has led to high spot rates and good period contracts. But if you look at the spot rate today, adjusted for an Ultramax, you're well into the 20,000s. And the FFA market, which you can see here on the left for Q1, Q2, Q3, and Q4 this year, is still trading at extremely profitable levels, even though it's down by 20% since before Christmas. There are several effects which are guiding the market over the past few months. You had 2021 and ending on a strong note actually, but now we're in actually the seasonally low point of the year, and this coincides usually with a slower period ahead of the Chinese New Year, which will this year occur between 1 and 15 February. You have a rainy season in Brazil, which tends to hit the Capesize and the iron ore trade. And you also have more adverse weather in Australia, which can sometimes postpone grain exports. When you put all this together, you see some negative factors weighing in on the spot market, but all of these are short-term seasonal and weather effects in our opinion. And there's a history back to 2010. Every single year, the spot market has turned up sharply after Chinese New Year. The only exceptions in 2010 was in 2014, when there was a bull market starting already in December. So the market took a break after Chinese New Year, but that was after rising quite rapidly both in December and through January. So the question is, what have we done with these rates? We've had a strong market 2021. Last year averaged more than $26,000 for a Supermax, close to $30,000 for an Ultramax. Since August last year, we've used this market to significantly de-risk Bell ships and the Belco share. We've engaged in many 1- and 2-year charters to some of the best charters in the dry bulk market. And this has basically put us in position today where we have 55% contract coverage for 2022 at close to 23,000 net per day. And in addition to that, we've also completed the sale of so-called non-eco older vessels. So in Q3 and Q4, we sold 4 vessels. Those 4 vessel sales alone will free up net cash of close to $50 million. And the contract coverage at $23,000 net basically ensures that we already know we're going to be profitable 4 quarters in a row, and the remaining open days in 2022 thereby have a negative cash break even. So that puts us in a position to know that we can pay a dividend throughout this year. And I would say that still today, with a slightly lower spot market, there's still activity in the period market, and we probably see a 1-year charter contract today would be around 24,000 for an Ultramax, and 2 years probably around 20,000. And it's likely that we'll engage in more period contracts like this, because we see that it gives a highly profitable cash flow compared to our break even at close to 10,000 per day, and it also solidifies a dividend capacity. And when our stock is trading at the discount both to NAV and a low PE, it makes sense in our view to actually de-risk and increase the visibility of the cash flow. And this comes to what you have to pay for this. And if you put in the contract coverage we have, and then you estimate a few scenarios on what the spot market is going to give us for the remaining open days, you can see here, if you start on the left here, on the assumption of $5,000 per day, this just confirms that we have a negative cash break even on the open exposure on 2022. So even in the $5,000 market, as from tomorrow for the rest of the year, you'd see a 22% yield basis the current Belco share price. And you can divide these percentages by 2, and that's your direct yield on the dividend we pay. So on the current spot rate, you get close to 40% yield, and half of that's paid out on a quarterly basis. So we feel that there's an unnecessary low valuation of the stock at the moment, and I don't think people are really appreciating or differentiating the fact that I think we're the only company at the moment which is guiding on the full exposure and contract coverage for 2022. So in conclusion, I believe we have a good platform. It's rigged to grow further. So if we find accretive deals, we're willing and interested to grow further, but we won't jeopardize our EPS and dividend capacity. We're not keen to inflate our cash break even. So as long as it ticks the boxes that it's accretive for us and the shareholders, we're still open to growth. I mentioned the contract coverage. I think the dry bulk market in general actually presents a pretty tempting opportunity at the moment, because what you're basically looking at today is that you have cash flow right now in the spot market, especially in our segment, that is highly profitable. You're in a low point in the season in January, February. Historically, as I mentioned earlier, back to 2010, it's the lowest point in the year. And it's not ship values which is driving the share price and valuation. It's the opposite. It's cash flow. And basically, I don't think I've seen, studying dry bulk cycles back 30 years to the 80s, you have to go back to 1985 basically to see a dry bulk proposition as an investment where you get immediate cash flow and then you hope the ship value is going to increase. Usually in shipping, you pay on the back of an increasing value on the asset, and then you hope the cash flow is coming later. So this time I find it compelling that it's the other way around, that it's that the cash flow is here, and then we should see an appreciation of asset values. So with that, I'll hand it back to you, Lars, and thanks for the attention.
Thank you so much, Lars. So obviously, you already mentioned the backlog and your coverage for 2022. So how much coverage do you actually think that you should take at this point in the cycle? I mean, what's sort of your target if rates stay at these levels?
That's a good question, and it's a somewhat dynamic relationship, because when we ended in 2020, we felt that we're coming from a low point in the market, and we actually kept 80% of our fleet open for 2021 because the rates were so low. It was rather easy to hope for an appreciation. Coming into this year, we had a year where rates have averaged 26,000. The best charters in the market were willing to pay close to that for 1 and 2 years, and then you see the share price is not valued on the basis of these levels. So then it makes sense to change tack and increase the coverage. So I'd say at the current time, we'd be willing to actually increase the coverage, whether that's, I mean, we're soon at 60% for this year anyway. But I'd say as opposed to the container market, in dry bulk, you basically fix vessels which are open within 4 weeks. So it takes some time actually to create the contract coverage. But I'm generally positive to increasing contract coverage when you see that the charters are actually there to pay decent rates compared to spot market, and the shares are not, I think, for any dry bulk company really reflecting the true earnings power.
In terms of liquidity in that the time charter market, is you know, the 1-2 years deal, 2-year deals at $20,000 per day plus, can you go out and do 10 tomorrow if you had available vessels, or?
Yeah, it's that's the beauty actually of dry bulk. Some people say it's a low barrier entry, but it's certainly a low barrier exit. It's extremely liquid. So we can fix 10 vessels for 1 year tomorrow. It takes a bit more relationship and work to do 2 years and longer, because also the charters, it's a bigger decision. But 1 year charters, it's highly liquid. Just 2 weeks ago, even though you have a falling spot market, we did actually fix a vessel for 2 years at around 21,000, and that's a relatively quick process. So I'd say 1 year very easy, very liquid. 2 years bit trickier, but still possible.
It is remarkable, because I remember the first time I met you, Lars, you had some legacy Bellships time charters at, I think it was $16,000-$17,000 per day for quite substantial period, and that was completely crazy. But now you're doing 2 years easily at above $20,000 per day. So that's a remarkable development, obviously. But you also talked about the access you have to Japanese financing. Obviously, you have grown a lot over the past couple of years. So I think this question has sort of 2 parts. Would you be keen to do more? And are those deals still available at attractive levels?
Yeah, I think obviously there's two factors there. There's the financing and the vessel prices to buy, and the financing is certainly still there. Earlier today we press released 2 new sale-leaseback transactions, and these fall in line with everything we've done earlier. So even though you've seen a 10-year rate increase in the US and here in Europe, we've actually done the 2 last ones now at a few basis points cheaper actually than the previous ones. So we just now finance more than 80% of the market value of 2 Ultramaxes, and we're paying all-in fixed interest rate for 10 years, 4.4. And the unique part of this structure is that we have the option to buy the vessels, but we don't have to at the end. The second part, whether we can do more, it's not so easy any longer to get these resales and brand new Japanese ships. So if they were there, we'd take them. Last year we managed to add 7 of these. So it's a bit more difficult to get hold of the ships actually, and I think I can count on one hand how many are going to be available in 2022.
Okay. And also, I mean, obviously growth also relates to capital allocation. So just to stay at that sort of path with this question as well, because you have a stated dividend policy, it's 50%, but sometimes during presentations and so on, you might get the impression that it might be a bit more than 50%. What would it take for you to do more than 50% in any given quarter?
Well, not a lot actually, because 50% is what we promised. And if you look at Q2 and Q3 payouts last year, it's actually been 59 and closer to 70% actually. So we're actually likely to deliver at least 50%. And the notion of growth is not necessarily against the dividend actually. The acquisitions, many of the acquisitions we've done have not only been accretive, but they've actually within the first year have been cash positive. So if I go back to the vessel I showed you on the presentation on the front, that was a new building, brand new vessel we bought, and we financed it through this lease arrangement in Japan. We spent $2.6 million to take over, $3 million in cash as a down payment for that vessel, and the rest is financed over a 7-year lease period. Those $3 million is in today's market is recovered in less than a year. So you know, if you have a cash break even of 10 and you earn 20 net thousand, it's back in 10.5 months. So we're going to continue sourcing growth opportunities along the lines we've done until now. And I think if they meet the criteria, it's actually because they're able to add the dividend capacity and not only in 2 or 3 years, but actually within the first year. So I think that's our main advantage, and it's why we can keep the door open actually at the same time. If you look at your analysis on Bell ships and our contract coverage, it's we can do both.
Good. So I think we need to wrap this part up as well. But as a final question, you will get the same question as Konstantin did. What could break this upcycle? I mean, the order book is very low, so.
Yeah, I don't think speculating on where demand comes from is not too useful, because demand is actually very stable. Relying on the order book is all right, but it's still a passive factor over the next 3 years. I think the main negative possible event is that if you had a sudden reversal of congestion, because I think basically congestion has tied up close to the same amount as we have in the order book. So let's say, for argument's sake, that it's the same 6-7% in congestion. So if you had a sudden reversal of congestion, you could have an entire order book in a quarter, and that would obviously take down the market short term. Looking at the container market especially, I don't think we can expect that anytime soon. And if this congestion lasts 3 and 6 months longer, we're really getting into an empty order book. So I would say congestion, but we're reasonably comfortable because the fleet is also operating at full speed. So if you had a sudden reversal in the market, you could actually balance out the congestion just by reducing 1 knot speed, which takes out 5-6% of vessel capacity. But I think that's where we're trying to focus or keep our eyes on number of vessels waiting and the number of vessels ballasting.
Thank you so much, Lars Christian. Now we have reached the final speaker of today's session. His name is also Lars Barstad from Frontline. Frontline is, as you all know, the bellwether in the tanker space. And I think that it's probably safe to say that the sort of mood in the tanker market has not been as upbeat as in the container and dry bulk in 2021. But obviously, given that where rates are, the tanker market can probably just improve from here. And investors may be looking at inflection points on the downside in container and dry bulk, but in the tanker space it's only inflection points on the upside. So with that, I think I'll leave the word with you, Lars.
Well, thank you very much, Lars. It's been interesting to listen to these guys talking about dividend yields and so forth. I can talk about it in theory, but I'm regretfully can't give our investors anything at this point in time. Let me just start with Frontline for those of you who may not know the company too well. So we run a large, diverse fleet of modern tankers. We have 74 vessels sailing the 7 seas. Our focus is on the VLCC, the Ultramax, and the LR2, which we like to call the VLCC of the product market. I think what typically is characterize Frontline is we have a kind of low break-even levels. We run a low, very efficient platform and a very transparent company, which is actually not that common on the street. Safety is high on the agenda for us, but as I mentioned, we try and strive to keep kind of a very tight ship, and this has been extremely beneficial for us in this down cycle that we've seen that started at the early 2020. We have a long track record of returning value to shareholders. We've distributed more than $6.2 billion over the years, but obviously not in the last few quarters. I'll jump straight on to kind of where why Frontline is kind of such an appreciated share in the market, because we have actually, despite despite kind of challenging freight rates, we have actually our share has actually performed over the last few months. Frontline has, as I mentioned, we run an extremely low kind of cost base. We have a kind of industry low financing cost, and we also have operational costs that are very low. This gives us kind of a competitive cash break-even level, and in a normal market cycle, we will actually be able to return quite a lot of cash to our shareholders. It's always a question that comes up with Frontline because we're priced normally above NAV, and investors continue to buy our share even if we're trading at 1.2 or even 1.3 of NAV. Well, we like to argue that there is a reason for that, and this is basically what's on the slide here right now. So if you look at the illustration on the right-hand side there, you'll find that free cash flow yield and free cash flow per share, even in a mid-cycle market, is significantly high. And obviously you could compare it to other industries, but this is kind of extraordinary, and it makes Frontline a better stock. We have for the last period of time experienced really struggling markets, and I'll like to kind of go through where we are now. I'm not going to dwell on much of 2020. 2020 was a strange year, where basically all the moving parts were going in different directions. 2021 was supposed to be the recovery year, and it has actually, in fact, been to some extent a recovery year. We're now in Q1 of 22, and global oil production is estimated to average around 99.5 million barrels per day. And mind you, we were kind of at the peak in 2019, we were at 101, 102. And after drawing 1.1 million barrels per day in Q4 21, we're expected to build marginally in Q1 22. So kind of the recovery is ongoing in the oil market still. Projected demand growth in 2022 is expected to come from non-OECD countries. And this is significant because during 2021, most of the recovery that's happened kind of globally on oil demand has happened inside OECD. And this is countries like Europe, US, and so forth. And these, for a tanker owner, it's not particularly interesting that these countries get the wheel churning, because they're very close to production, and they're also producing oil themselves. Basically, it's non-OECDs that makes, and in particular Asia, that makes a big difference for tanker ton-miles and tanker demand. But going forward in 2022, this is the region that's expected to account for 2.5 million barrels per day of increased demand, in addition, and then add 500,000 for OECD. We've been through a market now where kind of energy crisis has been on the headlines everywhere, and it's electricity prices, coal prices, natural gas prices, gas prices. It's basically every molecule has been peaking, but oil has been delayed. The oil price now, as we sit here, is signaling a tightness finally. Why oil has been delayed is basically because of elevated inventory levels. The amount of oil that was amassed in, firstly, land-based storage, then secondly, floating storage during 2020, which obviously benefited the tanker industry quite a lot, utilization-wise. I think it was underestimated how long it was going to take us to basically draw on all these inventories. And as long as you have oil in a tank nearby, you're not going to demand the marginal barrel from, say, the Atlantic Basin or US Gulf. We are now in a area where actually the OECD inventories are at record lows. We're back to 2014 levels. So there's basically no inventories left to draw off. There's another reason for the current tightness, and it's also, probably caused by production issues in Libya, Nigeria, Angola, and Ecuador. And there's also an increased political risk that's affecting the oil markets and secondly us. But there is one kind of good sign that we are hopefully on a path to reach a balance in the market. And I like to argue that the recovery actually started in October already last year. And that's when oil in transit started to pick up. I think this is probably a new indicator to many of you, but oil in transit is basically, it's almost like a quantish indicator, but it's very accurate. So every vessel traveling the ocean has what we call an AIS transponder, and the data from this transponder can be picked up by satellites. And what the vessel signals is basically its position, speed, and so forth, but also whether if it's ballast or laden. And if you sum up the laden dead weights, you basically get an indicator of how much oil is traveling the seas. And you can look it up on Bloomberg if you want to. So basically, oil in transit has then, since the bottom in October, gone up by 20%. And it's quite remarkable to see at what levels we are compared to the peaks of 2018 and 2019. So the kind of Q1 2020 peak is a little bit distorted because this came during the price war between Russia and Saudi, where Saudi basically opened the taps in order to scare off Russia. But we are, at this point in time, in an area where we should be as close to balance as we could be. And then just look at the fleets. This is for those of you who've seen Frontline present before. This is a well-known slide, and we, just as the dry bulk industry, are in a situation where the order books are record low. We're actually, for tankers in general, we have less dead weight on order now than in the beginning of 2000. And why this is important is basically because the fleet is twice the size it was. So it's not order book in percent of fleet when we talk about 30-year low. It's in absolute deadweight tons. So there is basically very little capacity coming in, and at the same time we have an aging fleet. The average age of the fleet has not really been this old since late 90s. So, but next year is going to see a few vessels coming. 6%, but 6% of the VLCC fleet is above 20 years, and this then against an order book of 8%. And if you, in addition to that, add up the VLCCs that will turn 20 years during 2022, you're getting up to 80 vessels that are, in one way or another, disqualified from trading. Whilst 47 new builds are coming. So we're actually not too worried about the order book. And this, for the Suezmax, is the same picture, but it's only more pronounced. There are 72 vessels over or passing 20 years in 2022. The LR2 order book is a bit more populated, but 15% of that fleet will pass 15 years during next year. And the LR2 is kind of operating under a slightly stricter regime than the tankers, meaning that normally an LR2 won't be attractive as a product carrier when it's past 15 years. And that's when LR2s tend to convert to be a pure dirty tanker and continue its life as an Ultramax. As I mentioned, VLCC order book stands at 8% of the existing fleet, Suezmax at 7%, and LR2s at 13% respectively. With regards to the order books, we had the MPCC presenting earlier on here, and that market has done some ordering, and that's actually a blessing to us because on the tanker side, you can't really find a significant amount of slots now until 2025. So once this order book is delivered, once we have kind of received the last vessel of 2033, there's extremely little vessels coming into our market, and these kind of order books are filled. So this is a situation I don't think the tanker market has really been in before. We had similar kind of setup back in 2003, 2004. But at that time, the yard capacity expanded, enormously quick. And we don't believe it's going to happen at the same pace this time around. But anyway, we're kind of the fundamentals of this market is set up for an extremely interesting market over the next couple of years. But again, we have yet to come to this point. If we look at the fleet composition, and this is very important because we're only a year away from IMO's kind of EEXI regulations to set in. And just to explain a little bit on the background of that, so basically every tanker, or actually every vessel in the world, is going to get what we refer to as a refrigerator rating. So basically, if you look at a refrigerator or a washing machine, you have a rating on kind of the design of that electrical part, and how much how efficient it is, and all the vessels will have that kind of stamp. And that gives you an index that then IMO will record, and then you are set up for a reduction over the next years. And it's basically we're supposed to reduce emissions or kind of energy efficiency on the fleet by 40% within 2030. And it means that when you get this rating, it's basically a letter rating, A, B, C, D. It's even an E probably in there. And if you have a rating when you start in 2023 that starts with C, you're already going to have a problem in 2023, because then you're going to be a D. And that's basically following the line of the reduction that IMO is advocating. You can change this, but then you actually need to do a physical change to the ship. And then we have another kind of a regulatory challenge coming up, and it's what's referred to as CII. And this is an operational measure on carbon, and it's basically your carbon intensity. So and it's an annual average that you kind of will get on your vessel. And this is going to be very interesting, I believe, to see how this plays out, because this would be closely related to whatever carbon tax or other kind of carbon penalties that will be set up on tankers. Frontline fleet EEXI is predominantly A, so we're in a very good position, and we don't envision significant capex to maintain B or above. The tankers are a little bit kind of in a better position than certain other segments, due to the fact that our vessels are normally a bit overpowered. It means that you have more power than you actually need. We have vessels in our fleet that are set up to go at 60 knots, which you never really do. You don't really need that. So it means that you could actually, by design, take away 10% of your power, maximize your speed at 40 knots, and stay within basically the forward regulations. So we are not really having much of a pulse up to 2026, and as per Bellship, we're actually quite comfortable into 2030 as well with the modern fleet we run right now. There's one very important thing to note here, is that vessel speed is the single most effective reducer of CII, and it's also kind of physical speed limitation is one of the best ways to deal with an EEXI if you are struggling to land at the sea or above. So this is going to have implications on the fleet going forward, but it's not going to be as pronounced as in, for instance, the dry bulk fleet, as far as I understand. But if you look at the fleet composition, then I've already been kind of pointing to the fact that we have quite an old fleet right now. And 6% of the fleet in the tanker space that we operate, so LR2, Suezmax, and VLCC, are actually already more or less disqualified to trade. And they're going to struggle to get the ticket to trade, basically being above a C or a C. But another portion of the fleet, the vessels that are built between 2002 and 2006, are going to have challenges, meaning that they're going to need investments to be done to reach 2026 safely. And then purely on the CII, so on this carbon intensity, a non-eco tanker will struggle. If you assume down the line that oil majors, national oil companies, and traders are going to start to measure kind of their carbon emission on their transportation needs, which they regretfully don't do now, then there is a much larger portion of the fleet that will have some sort of challenge. So this kind of adds up. If you put this on top of the lack of an order book, it's going to be quite tight out there. So I mentioned earlier on in this presentation that we have, all these vessels that are over 20 years already. There are vessels that are 24 years in this fleet, and they're not disappearing. We're not seeing scrapping significantly during 2021. Well, there is kind of a little glimmer of hope out there, because we are actually seeing recycling accelerating. And we've seen in 2021, if you look at the overall tanker fleet, we've actually had 2.3% of that total fleet removed from the market. It's very difficult for us to understand why you have record recycling steel prices. You have the most challenging tanker markets you've had for 30 years, to be quite honest. If you look back to Q3, a non-eco, non-scrubber tanker was making negative returns, and still we don't have a significant amount of recycling. But anyway, it looks like it's starting. It's not a particularly transparent industry, and it tends to be a lot of delay in reporting of shipwright recycling. For obvious reasons, it's not something you advocate when you are basically sending a ship to Bangladesh to get chopped up. But anyway, we are hopeful that we're going to see this trend continue, and that this will accelerate through 2022. Also to mention, the alternative use for older tankers for storage is non-existent. We're in one of the most backwardated oil markets we've had for many years, and there's absolutely no economics in storing anything at this point in time. I want to touch a little bit on the Omicron variant, because although for us some of us sit in Norway, some of you may be in the US, we're not really too concerned about Omicron, because we have efficient vaccines. We're seeing hospitalizations kind of fall, and we're seeing kind of this not having too much of an impact on our lives, apart from maybe the close of certain services or whatnot, and a bit more complicated kind of travel. But there are large populated areas on the globe that do have a serious issue with this. So I don't think we're kind of finished with Omicron just yet. But I think it's important to emphasize that we are actually in a far better place than we were in Q1 20 when the Delta version came. Sorry, not the Delta, the Alpha version came actually. So what's very much different is that oil inventories are not as high. So we're actually down to very low inventories, and we're most likely scheduled to build inventories going forward, which means that production has to go up, and then transportation will have to go up. So even in a scenario where Omicron hits demand by 1 to 2 million barrels per day, predominantly in Asia, tankers is not going to fall off a cliff from here, that's for sure, because it's not going to impact us to the same extent. Inventory draws is really bad because it just takes away oil. You pick it up from next door instead of transporting it. But inventory builds are actually quite good because it adds to the demand. So in addition to the consumption that increases, you add a few barrels to fill up the tanks too. So and also not to paint a too much risky picture. Vaccination rates are actually high. And I was quite surprised looking at this chart where actually if you account the vaccines that have been put kind of into people, we have actually vaccinated literally the whole population once, and some countries 2, and some other countries 2.5 times now. So we're in a very different place than we were back in 2020, and this is also potentially the reason why oil prices is not reacting in the same manner as it did the last time around. So if you go to my summary, so demand and supply of oil, it continues to rise. And as I've just mentioned, the Omicron version is seemingly, giving a modest or having a modest impact on the market. We see that the tanker markets have recovered since Q3 21, but it's still challenged by supply, not fully kind of at pre-pandemic levels. And one comment I would like to add on that is that a lot of people in this market are focusing on indices, and in particular like the Baltic indices, to look at what the tanker is earning. And I think we've proven that now for a year already, that these are not representative for a scrubber-fitted modern eco tanker. And there's no triangulation in this indices, and there are no bunker hedges, there are nothing in these indices. So it's actually representative of a 2010 built VLCC, non-eco without a scrubber. And yesterday Baltic printed minus $5,000 per day on a AG to China run, and it's actually it's closer to $10,000 a day on the modern proper ship. So one should be a bit careful kind of putting these numbers into your models. Yeah, I mentioned the tanker recycling is finally starting to make an impact on supply, and I think this is going to increase going forward. I'm quite confident it will. We have a lot of moving parts in the tanker industry right now. US SPR release, we've seen a high correlation of US SPR release and US exports. So that just adds barrels to the market. The OPEC strategy going forward is going to be interesting now when crude is flirting with $90. And we have the resumed Iran nuclear talks. Why that is important is that right now we have kind of a shadow market in the tanker industry, and this is maybe one of the reasons why we have so many old tankers still trading. And it's basically the transportation of sanctioned crude. So both Iranian and Venezuelan sanctioned crude is being transported around the world on ships that are not really playing a part in the compliant fleet at all. The one way to stop this illegal trade would, of course, be that Iran and the US kind of came to an agreement, and they were allowed to export freely again. That would mean that the new barrels, or these barrels from Iran, instead of going on illegal tonnage, would actually have to go on compliant vessels. So that could be like a very interesting point. How likely it is? Well, it's very difficult to say, but it's actually more likely now that the US may compromise with this crude price. So let's see. Oil in transit continues to rise, and energy prices, as I mentioned, are at record highs. And we're in the northern hemisphere, we're midwinter, which normally is good for demand. Frontline's kind of financial commitments, where we're fully financed. We have actually reduced our overall financing costs. We feel we are in a position where we basically close the hatches, and we're ready and feel we're well positioned to see how how this story unfolds and when we get to this inflection point. I'd like to just a small comment on the final graph there at the bottom of the page, because I started using this actually on an Arctic presentation about 2 years ago, and the yellow line there is the year-on-year growth indicators for tankers, and I've actually been in negative territory for a long time, and now we're actually year-on-year printing positive. So it's this indicator is basically a mixture of fixtures, ton mile, sailing distances, whatnot. So we are actually in the move. So with that, thank you very much for listening.
Thank you, Lars. And once again, we turn over to the Q&A session. Obviously, you have talked about several reasons as to why the market has not been very good, and also several reasons as to why it is in fact recovering. But if you think about it, the tanker recovery has been pushed out several times over the past 12 months. So, as you know, a simple rule of thumb for investors, what is the main indicators to look at to catch this recovery?
That's a very good question and a very difficult answer, to be quite honest. I think the strongest kind of long-term correlation and the best indicator is actually global inventory draws and builds, and this is actually something you can mathematically prove. The challenge with that is that the global oil market is actually not particularly transparent. And when big reporting agencies like EIA, IEA, and all these guys, and OPEC even, when they are reporting inventory builds or draws, they have no idea what's going to happen going forward. It's at best a 3 months look back, because this data, OECD is US is accurate and live, Europe is accurate but not live, and the rest of the world you don't really know for sure. So this creates kind of a challenge in measuring that. But at least if you should believe in all these bright minds, we are moving now definitively out of the inventory draw cycle. And we did that in December by kind of doing a final draw of a couple of million barrels per day. But if that's correct, who knows? One of the reasons I was bullish second half 2021 was basically because at the time EIA, IEA, OPEC, everybody thought we were finished drawing in August. So it is that just tells you kind of how difficult this market is to gauge. But I think that's the key indicator, and if we one signal that maybe supports this inventory draw or build is basically what's going on in the crude markets right now, where it seems like demand is kind of asking for more barrels than what's in stock.
Yeah, definitely. And in terms of more barrels, if you look at the production figures stipulated by the big agencies, it looks like OPEC is probably gonna be at and this is crude, around 29 million barrels per day of crude production towards the end of this year. That is more or less in line with what we saw late 2019. And is that what the tanker market is waiting for? And is it a problem that in terms of ton miles, that it seems as though maybe the member countries in West Africa is actually struggling to put barrels back into the market?
That's a big yes and a yes. So we basically, what we see on the ground is that the Middle East is actually back to pre-pandemic levels. We do cargo counts. And for us, a cargo count above 130 VLCC cargoes each month, is a normal kind of business day. And we reached that actually already in October last year. So we think kind of OPEC Middle East is doing quite well. But you touched upon it, OPEC compliance is, last time I saw, now at 116%. So basically they're over compliant with kind of their volume reductions. And this has to do with specific production issues, and then particularly in Nigeria, to some extent in Angola, and then we've had a very kind of volatile output from Libya. So basically what we actually need in our market is for US to go full throttle, and that doesn't, it's actually not looking to do that just yet. But we do see healthy exports from North Sea as well. But I think it's right now we are at a point where crude is gonna lead the way. People actually thought crude was over when Omicron came, for a while at least, and now the headlines are all over $100 crude again. And if we see that within a couple of months, I'm pretty sure we're going to see a lot of oil kind of hitting the water.
And I mean, it appears as though in terms of oil supply, it seems as though OPEC certainly, and maybe as we just talked about, AG is in the driving seat here. Is it a problem longer term that we may have seen somewhat of underinvestment in maybe the Atlantic basin producing countries? Is that a possible risk for the tanker market longer term?
Definitively. But I think we have to remind ourselves that the big swing producer in the Atlantic basin is actually US. We've had increased production in North Sea. Brazil is on schedule and is actually increasing kind of all the time. West Africa is always volatile, but I think that the big swing producer is going to be US, and we actually although we see Middle East supplying kind of up to what they do on a normal month. It's still discussed, how much spare capacity does the Middle East countries have now, because there are, they do miss their quotas too. So it's I'm not going to kind of put all my faith in the US, but we need, as the world surpasses 100 million barrels in demand, we basically need kind of all oil to move. And that includes US as well. And people are always underestimating US ability to ramp up. They need the right price signal, and then it normally comes.
Good. So I think we've talked a lot about the demand side here now, and you also mentioned scrapping, or rather the lack of scrapping, apart from maybe the last 3-4 months of last year. Why haven't really owners, I mean, given high steel prices and thereby high scrap prices, and as you allude to, a negative $5,000 per day earnings in the spot market for older vessels, why haven't we seen more scrapping during 2021?
No, it's crazy, to be quite honest, and I think that poses kind of a supply risk to the tanker market. So because in a normalized market, look a year ahead, I think that in order for tanker rates not to take, we're in an inflationary environment now, and just looking at the balances in tankers, tanker rates, we could end up in a situation where we don't have the transportation capacity we need to transport oil, and that's a serious problem. It's not, well, I shouldn't underestimate the seriousness of container business, but kind of, that you can't get your dole for Christmas, that's maybe you can live with that, but that the refinery can't get hold of the oil it needs to run, that's a bit more complicated. And that's not good for any markets, to be quite honest. You make an insane amount of money for a short period of time, and then basically an alternative will appear. So and the fact that we have a large portion of the fleet kind of unscrapped right now it's a mystery, and there's probably many reasons for that. One, you could say that amounts to maybe some of these vessels is that quite many tanker owners do not only own tankers, so they have other segments as well. And then it's actually a relatively cheap call option just to keep that VLCC or those 3 VLCCs floating, because if you get a spike, you'll be able to pay that. Residual value is probably, you've written it down to 0 already. There's probably no leverage on it, and you just keep it kind of steady and ready for a spike. But I don't think that's like a huge portion of the fleet. And then you have obviously all these vessels that documented are doing dark activity. The ones that sail without insurance, they sail, kind of the crew is not protected. It's actually a massive environmental risk, and that will stop eventually. And then we'll suddenly wake up one morning, and we have a kind of a severe supply situation all of a sudden in the tanker industry. But I don't have a good answer, to be quite honest. It's kind of, we're growing into a situation here that I simply struggle to comprehend. That's why I think that, we are gonna in fact see the recycling activity pick up significantly going forward.
Thank you so much, Lars. So we are running out of time here, but I'm not gonna ask you the same question as I asked both Konstantin and Lars about significant risks of killing a cycle. So rather, I'd like to ask you about growth, because obviously you have added quite a few vessels during 2021, mostly through resales of VLCCs. Are there possibilities for more? Are you looking at more? Or, I mean, you have premium pricing, you have access to the best financing in the industry. And I mean, some listed peers are seeing quite depressed valuations. Are there possibilities of consolidation?
Definitively. We're and this is like a broken record for Frontline, but we're always looking at opportunities, and we also have the ability to move, even almost regardless of where we are in the cycle. But I think we have to admit that we did a fairly aggressive investment last year, kind of increasing our VLCC fleet by, in deadweight terms, almost 30% overnight. And we are at any point in time looking for more, but it's always a consideration that when you see the markets a little bit delayed, you see maybe some owners getting tender as to where they put the pricing and so forth. We will sometimes just pull back and wait. Where we are now, I can't really tell you.
Okay, Lars, thank you so much for taking the time. And I'd like to just, try to sum up with a few of my notes here. So MPC, the container market is not cooling down. Rather, it appears to be actually heating up, and dividends will flow. Bell ships rates are at 2 times cash break even, despite the fact that we are in the slow part of the year. FFAs are pointing to a very strong market, and Bell ships with its coverage will make money regardless of spot rates. Frontline, the market is about to turn the corner, and in that event, Frontline is certainly the tanker stock to own. With that, I'd like to thank all the presenters for taking the time, and also all attendees for taking the time as well. Thank you so much.
Thank you.